Did you know that you can turn crypto crashes into profits? Yeah, when the dip keeps dipping, traders have a way to not just offset their losses, they can even generate a profit. Now, this might all sound surprising, but tools like this have been essential parts of the economy for decades. From soybeans to silver and cotton to cryptocurrency, futures contracts are the underlying engine powering the global commodities markets. But while futures contracts allow you to unlock more advanced trading strategies, they also have some additional risks, as well as a reputation for being harder to use. So, let's simplify things using Kraken Pro and highlight some key factors to consider as you make futures part of your crypto strategy. Futures are contracts where two parties agree to trade an asset at a specific time, at a specific price, in the future. Futures are a type of financial derivative and have been used for centuries to help traders protect against unexpected price changes. They also allow traders to develop more advanced trading strategies. You can use futures to go long and profit if the price of an asset increases. You can also use futures to go short and profit if the price of an asset decreases. But of course, like many things in crypto, there's a slight twist. Most platforms offer a special type of futures contract, known as a perpetual future. Unlike traditional futures, perpetual futures have no expiration date. Instead, they stay in sync with the asset's market price using something called a funding rate. The funding rate is a payment exchanged between long and short traders. The amount paid, as well as the direction of this payment, updates every hour on platforms like Kraken Pro. Let's check out a simple example of how futures trades actually work using Kraken Pro. Imagine Bitcoin is trading at $100,000 and you expect the price to drop. You deposit $1,000 on Kraken Pro and use that to open a short position. Bitcoin drops, let's say to $80,000. You decide to close your short position, buying Bitcoin at the current market price of $80,000 before immediately selling it for your contract price of $100,000. With this one trade, you would have earned $200 in profit from your $1,000 deposit, plus or minus some small fees incurred along the way. Say you expect Bitcoin's price to rise. Let's check out an example of how you can use futures contracts to profit from price increases as well. Again, let's say Bitcoin is trading at $100,000 and you use your $1,000 deposit to open a long position this time. Bitcoin rises in price, let's say to $120,000. You then choose to close your long position, which buys Bitcoin at your contracted price of $100,000 before selling it for the current market price of $120,000. Again, that's a $200 profit, minus any small platform or funding rate fees. With futures contracts, you never own the underlying asset itself. Instead, you buy a contract to buy or sell the asset at a certain price in the future. This allows traders to speculate, hedge, and actively manage their crypto portfolios, all without having to worry about the complexities of crypto custody. Next up, hedging. Although you may have heard of this term, it might not yet be part of your crypto strategy. A hedge is a trade that offsets risk by taking a directionally opposite position to an existing trade. In this situation, your original investment can lose value, but your hedge would actually gain in value by a similar amount, which would help you offset the loss. For coins you plan on holding for the long term, you can use futures to help protect against short-term price volatility. Let's say you own one Bitcoin and are worried about its price decreasing, but also don't want to sell it. As an alternative, you can choose to open a futures contract with a short position worth one Bitcoin. If Bitcoin prices fall, your Bitcoin holding will be worth less. But your hedge or your short position will be worth more by nearly an equivalent amount. By generating a similar amount of profit as the loss you'd experience from holding an asset through a price dip, futures contracts allow you to protect the value of your crypto portfolio. And if prices rise instead, your short contract would lose in value, but your Bitcoin would increase in value, once again balancing out the profits and losses you'd experience across your spot and futures positions. For the small fee of opening and maintaining a position, hedging can offer you peace of mind during periods of high price volatility. Feeling good about a particular trade and want to increase your potential for profit? Futures platforms like Kraken allow you to put your crypto to work by using it as collateral. While this leverage has the potential to increase the size of your profits, it also has the potential to increase your losses as well. So let's check out how leverage works in practice. Let's say you deposit $500 worth of an asset into your Kraken account to use as collateral. With 10x leverage, that $500 allows you to control a position worth $5,000 in an asset like Bitcoin, which might be trading at a market price of $100,000. You decide to go long, and Bitcoin's price rises by 10%, from $100,000 to $110,000. Your $5,000 position also increases by 10%, earning you $500 and doubling your initial deposit. That's 10x more than you would have earned trading without leverage. But leverage works both ways. In this example, let's again say you decide to go long with $500 at 10x leverage. But this time, Bitcoin drops by 10%, from $100,000 to $90,000. Now, your $5,000 position would lose $500 in value, completely wiping out your original collateral of $500. That same 10% price move against you would wipe out all of your initial collateral, causing the exchange to automatically close your positions to prevent further losses through a process known as liquidation. Yes, I said it, the L word. If your position loses a significant amount of value, the platform may issue something called a margin call, asking you to post more collateral in order to keep your position open. If you choose not to maintain your margin, there's a good chance you'll be liquidated, which means having your position automatically closed. With 10x leverage, a 10% move in your favor can double your money, while a 10% move against you can wipe out your entire position. That's why it's important to manage your risk and remember that you're trading with borrowed funds. When it comes to leverage, stay humble, start small, and avoid situations where you risk more than you can lose. Also recognize that stop loss and take profit orders exist for a reason. With futures, it can be helpful to have your entire vision for a trade set ahead of time, so you know exactly when you're getting in and out of your positions. Ready to make futures part of your crypto strategy? Here's how you can get started on Kraken Pro. First, check that futures trading is available in your region. Then, sign up on the web or download the Kraken Pro app on your phone. From there, you just need to answer a few questions, fund your account, and you're all set. Kraken Pro lets you trade without trade-offs, allowing you to access deep market liquidity, flexible order types, and a fully customizable dashboard, so you can build and execute your crypto strategy on your own terms. While traders value our execution speed, liquidity, and order book depth, they also count on Kraken's battle-tested reputation for security and reliability. Futures gives you the power to hedge, speculate, and trade with precision, while also giving you the flexibility to profit no matter what direction the market moves. But they also come with some unique characteristics and risks that you should be aware of. Whether you're looking to protect your portfolio or level up your trading strategy, perpetual futures on Kraken Pro can be a powerful way for you to take control of your crypto. Follow Kraken for more, and we'll see you next time.